Okay, okay. Good morning, everyone. Okay, so this is a hybrid event, right? Those of you who are having your food, okay, can listen. For those of you tuning in at home right now online, we'll give another 5 minutes for people to come in and settle down. Okay, thank you very much for your patience.
Recording in progress.
Okay. A very good morning to everyone. Okay, okay. So thank you for tuning in on time. Right, those at home, right, those present here today. Thank you for taking time from your Saturday morning to attend today's seminar, hybrid seminar. Okay, so today's topic, right, is China and Asia market outlook for quarter one 2024. So I think most of you today attend this seminar is because you're curious on how Asia or China is going to perform, right? The 2024 is supposed to be the year of Asia, but Q1 already so choppy, so volatile, suddenly got one downswing. So that's why today we got three experts to share more on the Asia market, and hopefully you can take away something from it. Maybe some of you are holding on to investments that are focused on Asia or focused on China, and you are concerned about the performance. So that's why we specially organize this Q1 event for you to ask questions, to see how things are going to go down the road, maybe not next year, but maybe even 2025, right? Okay, so I shall pass over the time to the very first speaker, Colin Ng. Okay, he's from Head of Asia Equities from UOB Asset Management. Let's give him a round of applause. Okay, thank you, Colin.
Okay, good morning, everyone. I'm the head of Asian equities from UOB Asset Management. But before I start, I just want to wish every one of you all an advance, prosperous new year for the year of dragon. And I hope that over this session, how much time I have? 30 minutes. I try to cover as much as possible. And if you have any queries, we can actually, I'm very happy to answer your questions during the Q&A session. The title here seems to suggest that last year has been a terrible year for equities, and that come the year of dragon, China being the dragon, it should be the time for Asian equities. Okay, I'll cover a bit of the outlook first. I'll start off from the macro and then drill down to Asia, and then I'll have a brief introduction on our product, and then just to overall as a summary. Okay, the case being here, I'm giving a broad picture first, is that we believe that the global economy will still be trading well into 2024, more resilient. In fact, later slides, there are some growth that we are seeing globally. We believe that this year should be a rebound for trade, for exports. I think last year what we saw was that some of the overall trade numbers were pretty weak for those export-oriented countries like Korea, like Taiwan, even for China. But I think going to this year, we are seeing a bit of recovery already. And that corporate earnings should be all right going into 2024. Then we are also looking at interest rates, broad picture. Although I think the market is anticipating more cuts. At one stage back in December, we are talking about 6-7 cuts in interest rates. But what we believe that interest rates has peaked. And now going forward is when the Fed decides to cut interest rates. In our view, we are thinking about 3 cuts, for 2024. Somewhat, I think we are a bit more cautious because there are still certain global political events, for example, in Middle East, where if that escalate to a regional conflict, then oil price may move up And as you're all aware, I think what happens in the Red Sea here is that also has led to freight rates being higher for those goods going to Europe. You know, that has implications for inflation as well. So overall is that, you know, I think the central banks are also watching it, and they wouldn't act so quickly to cut. Although I must say that inflation, U.S. inflation, seems to be contained, and it's actually now waiting for the Fed decision cut. So overall here is that we are still all right to invest in bonds. I think there's a range that we highlighted here from 4.25 to 5. But I think generally speaking, if interest rate is to be cut, especially towards the second half of the year, then certainly your bond investments, your yield goes down, your price goes up, then you'll make a bit of money from fixed income investment as well. Okay, this is not from UB, but this is from IMF. This data shows that if you look at one on the far right side, is that the global growth, is likely to move from 3.1 to 3.2%, as you can see here. So slight growth, but certainly much better than what we saw last year. I think there's a bit of tentative because Fed was trying to increase interest rates to ensure that inflation doesn't break away. It was a very tough period for stocks. But there again, as we saw over the end of November and December, equity market actually reacted very positively, on that basis. But that's it, because of the high interest rates, that US is now facing, from almost 0.5% to 5.5%. We think that will have certain impact on the US economy in terms of GDP growth. So that's why you see on the chart here, that I think even IMF also recognized that it will be a bit slower in terms of growth. That's it. Just again, maybe something more relevant to all of us here is that Asia's growth will be stronger. Although you looking at the chart here is that it's actually falling, but where I want to highlight to everyone is that at least where you can see here is that Asia is still the region where we see the strongest economic growth. So even at 5.2% is way above those in Europe, in US, in other emerging markets or economies. Okay, what is our view here then? We, going into 2024, our view is that if economy is still firm, on a firm footing, and with likely interest rate cuts, then you all should be aware that when interest rate cuts, the one that normally react more positively is equity class, and therefore, in that aspect, we are overweight equities, and given that fixed income will also do well when US interest rates are lower towards the end of the year. And therefore, we also, affirm a more neutral holdings in fixed income. That said, I think where we take the balance from is actually from cash. Although I know that all of you are very happy, earning your MAS bond yield at 3.5, but you can see that it's actually also falling. So you all may consider to lock in at 1 year, given that interest rates are likely to be lower, towards the end of the year, second half of the year. Okay, in terms of where we like equities, is that we maintain a neutral stance in US. Why is that so? Is because for one thing, I think US equities have done very well last year on the back of earnings surprises, corporate earnings surprises. But that said, I think in terms of valuation, it is actually considerably trading at premium to the other markets. Europe, we take a tick down and we actually allocate more to Japan, Asia ex Japan, for the reason that I stated earlier, is that Asia is still facing will experience a strongest growth globally. So on that basis, that's some of a big picture in terms of our house view. If you look, if you drill down towards why Asia ex Japan or why Japan, for example, you can see here is that if you compare valuation, US is trading at almost from 20 to 18 over times valuation. But those in Japan, in Asia ex Japan, or even in China, for example, are trading a lot cheaper, more attractive in our view in terms of valuation. And not only that, okay, they can provide you a bit of dividend yield. But more importantly, I think in terms of price to book, they are, I would say, trading close to recessionary type of scenario. Normally when we, during the Asian financial crisis, when I do cover the stock market or even global financial crisis, when we have recession, I think normally the market will trade around 1 times price. And that's where you want to, you probably be very contrarian in your thinking, and but we are almost there now. Although I actually don't feel that there is a recession, although in Singapore we're just talking about a very low kind of growth, around just 1% kind of GDP. Sure. These are all MSCI data. MSCI. We take from these are the market expectations for that data. Okay, so just put it that way is that I think we are in this part of the world. I hope that all of us can live at least another 20, 30 years or even 50 years longer. The point is that, that there will be transformation for the Asia region. This is something, we understand from 2050 is that another 25 years is that, Asia will have at least 4 countries, as the top 10 economy. So you all know that right now is China, Japan. I think India will be there as well as Indonesia. So this, over the next 25 years, certainly a lot more attention, will be accorded to Asia. Certainly also is that the fact is that I think the huge population, I think, I mean, a lot of markets are all writing about China population decline. But I think China has a lot of people. It's not really a problem. I think the situation here is that the demographics, you want young population. And then in this instance, India, Indonesia has actually very young demographics. So they have a lot more new babies, for example. And unfortunately, I mean, for countries like us in Singapore, we probably rely on immigration. But there are certain countries that, will not rely on that method of increasing the population. But that said, I think what we are also seeing is the influence of growing affluence. We are the region where we are not as rich as the Western economies. But that also means that we have actually potential to grow. Just like in Singapore, for example, our income per capita is a lot higher and comparable to Western economies. But in countries like China, India, Indonesia, I believe that there's actually a lot more room to increase higher in terms of income per capita. And that will means that there will be actually a lot of opportunity in some of these domestic consumer stocks. So just to give you all some insight. Okay, so what happens here is that I know I would expect you all to read very widely, and that, China's growth last year was 5.2. So it was actually meeting their internal expectations, although the market initially expect China to grow even as high as 6%. That said, I think going into 2024, the market is describing, only 4.6% growth for China. But I wouldn't say only in the sense that I think China has done a fair amount of job, given that you must understand that, there is geopolitical situation between China and US, and that, how, China under all that under a period of suppression from US, to be able to record at least above 4% growth is actually pretty steady. I think it is a good accomplishment. That said, I think areas where we also see pretty strong growth is that of India. So later I'll talk a bit more on India, but India certainly has been captured, in a lot of radar screens for a lot of investors. And that, Singapore's growth 1.2%, we are growing a bit stronger, 2.3. So it's like the same, like Korea, from 1.3% last year to 2%, same for Taiwan. So again, that's why we highlighted that last year has been a tough year. A lot of Asian markets, Asian economy. But going to this year, 2024, at least, if you look at the macroeconomic top line numbers, seems to suggest that at least, we are, at least stabilizing and, in terms of economic growth. Okay, where we are also monitoring very closely is the export front. Okay, if you look at the charts here, is that there's actually a period, especially last year, where exports were down. In fact, there was countries, you look at it, minus 20%. There were countries like, I think, Taiwan, Korea, were down double digits. But what happens is that I think the last few months seems the data in terms of export seems to suggest that, things are actually picking up again. So we are, I would say, cautiously optimistic that, this year, maybe, I would think that Europe will be a driver of this demand, and that will at least help Asia. Why I say it's important is because Asia is still the manufacturing factory for the world, especially China. And that, with a recovery in exports or so-called demand from US and Europe, that will certainly be helpful in the overall recovery in Asian economies going to 2024. So, I would think here is that although we state that Asia does very well in consumer electronics, industrial electronics, EVs, I think most of them are actually from China, for example. Yes, semiconductors possibly from Taiwan, but overall is that we used to be very strong in Asia. We always selling the cheap stuff 20 years ago, like textile, like toys, like footwear. But these days, I would think that if you look at the data showing is that, China in many ways have contributed to that as the economy has been in transition and selling a bit more higher value stuff. So, we are no longer, China is no longer just doing footwear, t-shirts, which commands lower margin. But now, because of their transition economy, they are into producing or manufacturing things that commands more value, more margins. You all probably heard a lot on EVs, for example. But you all should also know that China is also building their own commercial aircraft other than Boeing and Airbus. So these are all technological advancements that, I think, investors may or may not understand, but, these are certainly, certain milestones to be highlighted for the manufacturing capability of China. So on top of that, you can see here in this chart is that, over the years is that I think we used to be just contented to be manufacturer, but I think what we are showing here is that, Asia is spending a bit more on R&D. So that's why here you can see here is that in terms of intellectual property rights, they are also commanding a lot more. I mean, the one shaded in bit of beige color, for example, are showing that, again, in this area is that we are trying to gain in terms of global market shares, because the fact is that, some of these Asian companies, especially China, is actually, spending more in R&D, and that, basically contributed to what we believe is that over time, more dominant, all these high-tech areas. So we talk about the higher value added, for example, higher value added manufacturing, for example, electric vehicles, for example. I know that a lot of governments are pushing for, renewable energy transition. So we want to be green energy, want to protect the environment. And therefore, if you all observe, over the past few years, and it will again accelerate over the next, I think over the next 10, 15 years, is that there'll be more push for EVs, renewable energy. And you all probably read from news is that China is now the #1 producer, overtaken Japan in terms of exporting EV cars. This is like a big change, in terms of the old, well, I would say old, what we term as the old combustion engine cars. China can never overtake them, because these are Western, so-called Western technology. And for cars, they are, high, I mean, in terms of value, it is a lot higher. You have to produce a lot more T-shirts, and the margins are a lot better when you manufacture cars. And for China to achieve what they are doing right now, it actually takes up a lot of, strategic investments. And China isn't here just because a few companies like BYD started to invest in EV technology, but they actually started the effort 10 years ago, to build this area, focus their investment in this area. And if you look at it, is that suddenly, China was able to overtake those cars that are made on the previous technology, which is your combustion engine cars. Okay, maybe you all may not see it in Singapore, but over time, you can see there are more Tesla cars, for example, or some BYD cars on the road in Singapore. And the government is also giving some subsidies on EV cars. This trend will continue, for the next 10, 15 years. And over time, is that, they may not do away over time on combustion engine cars, but certainly that will be the area that you want to focus your investments. So, these are talking about technology. It's just like your old handphones, for example. Those days, everyone is so proud of owning a Nokia. So like now, everyone's so proud of owning a Toyota, Mercedes, or BMW. But over time, 10 years later, everyone is holding an Apple phone. Some may hold even a Huawei phone, for example. But the point here is that I think 10, 15 years later, you all may not be driving your old combustion engine cars anymore. And I think it's a fact here is that China is very strong in this. And also because is that they are very strong in the metal mining sector, where they basically is the dominant seller of EV battery materials. So, once you dominate that, and the point is that the US and Europe didn't spend enough and didn't react enough, fast enough. And in order to do that, they'll have to take at least 10, maybe 5, at least 5, 10 years to push, in terms of their upstream, at least a decent market share in terms of the upstream mining in order to be successful in the battery space. So this is something for all to be aware of. And again, here I just want to show some of this slide. Just be focused on the slide in this corner here. On the overall, over the last, I would say, last 10, 15 years, is that you see China initially wasn't very dominant, but right now is that because of when China produces, these days they can produce with quality as well as with scale. So you have quality and scale means your cost of production is a lot lower and they are very competitive. You can check with your business friends, and the fact is that because of that, China is very dominant in all these areas. So, so if you read the news, is that if the Western economy, so-called Europe, for example, or even US, wants to push for renewable energy, green energy, then China being so dominant in EVs, in wind turbine, in solar energy, for example, has to be a credible part of this transition, the green energy transition. We cannot do without China in this aspect. So again, here is that I know that because of geopolitics, also because of the ongoing war, for example, some of this effort may seemingly slows down. But again, because every year they have this meeting like COP26, COP27, just to talk about climate, this fight to protect environment because our planet, temperature is increasing. So a lot of government is actually pledging a lot of money to China to this area. And if you have to build more wind turbine, have to build more solar panels, then who you buy from? Who can you buy from? At a cheaper cost. So you have to buy from China, and China manufacturer in this sense will gain from it. So maybe let me come back to the market. As you can see, how to read or interpret this chart is that the bar code will basically give you the range in terms of the valuation, where the red line is showing you where is the median, the average, and the green triangle will show you what is the current position, current level of the valuation. So as you can see here is that, China, Asia, is actually cheaper than its mean. For ASEAN, it's actually at the low end of its mean. For China, Hong Kong, in some way, Malaysia, Philippines, Singapore, we are all trading at the low end of our valuation band. So this is a valuation band for some of these markets. But generally speaking, we are trading at the low end of the valuation. So in that sense, is that a lot of negative probably in the price, and that you need some catalyst to re-rate the market. So markets will go through cycles up and down, but I think where we can access, where investors have to basically assess, is it the right time to enter into the market for an investment decision? Okay, we have some costs here. Overall, we like markets like Hong Kong, India, Malaysia, Singapore, Thailand. These are markets that we like currently. Markets that we don't like at this moment. Although I talk a lot about China, but I'm very objective. You see, at the end of the day, you all can ask me about why China, why not China. But unfortunately, where we are coming from is that there are certain risks that we have to be at least comfortable when we decide to increase our position in China. We have an underweight call on China. Same for South Korea as well. So just for benefit of everyone, and neutral call in markets. But these are smaller markets like Thailand. Maybe just want to highlight to you, these are our Asian capability. I'm not asking her to work, but just to show you, this is our Asian capability. And if you look at the performance on a 1 year, 3 year, so let's look on the 1 year basis. So this is as at 31st December. So 1 year is the same as year today. But what it says here is that the index, the index is the purple line. It's up 5%. Our peers struggle a bit, and the blue line is us. So we are doing better than the peers. And I think same for on a 3 year basis. The market is finding it pretty challenging. At the same time, we are down, but we are down lesser than the market and peers. And finally, on a 5 year basis, we continue to be stronger in terms of market performance as well as the peers. Okay, this is just the graphical chart. So, okay. Unfortunately, we are not the US. If US, if you have invested money in US, in S&P, even using the ETF, you have probably earned a lot. But because we are in Asia, there are certain investments risk factor that we face because we are still considered emerging market. But I think where I want to draw your attention here is that right now these 10 holdings, we don't have, these are publicly available. The fact is that right now is that I think in terms of where our allocation are, is that we are still more into markets like India, Taiwan, less of China. You may say that, oh, this is a big momentum because China is so low already. Why don't we get in? And but as we understand, we need to see certain things that happen in China. We are getting close there, and we believe that if the government is able to resolve its real estate situation, then things will actually turn a lot stronger for China. Okay, this is against the benchmark. I think we are so-called professional managers, so we have to be very objective and take away some of the subjective thinking. Although, we like China, but, it's not for the short term. There's still a lot of problems. Maybe just briefly state where we want to see when is the right time to invest in China. The fact is that if investors is expecting what we term as a bazooka stimulus, this big bang stimulus, 1 trillion, 2 trillion, to pump up the economy, pump up the consumption, then you are likely to be disappointed. Because so far the measures have been very piecemeal. I understand is that maybe investors may think that, oh, China wants to shore up the consumer confidence, but you also all must understand is that given that there's this US-China political tension that may last next decade. So therefore, it will be unwise for the China leadership to spend a lot of money right now, just to prop up the market. I think where they are focused on is, the economy, the transition in economy, transition it to be a more highly value-added manufacturing, for example. The Chinese government also, last 3 years, they talk about common prosperity drive. They cracked down on big internet companies. That was 3 years ago. But at the same time, they also cracked down the property developers. But right now, what happens is that as the property market in China consolidated for 3 years, it's not collapsing, I think you all must be very careful when you read Western newspaper. They're all very negative about China. I also read the Western newspaper. Unfortunately, you have to differentiate what are facts, what are just their personal opinion. So therefore, if you look at the data, GDP growth at 5.2% for China last year is actually decent. China is not collapsing. But unfortunately, there are still, the fact is that companies like Evergrande, Country Gardens, these are very big developers. They are going into financial difficulties. They have to sell land, sell units to raise cash. And that may be a dampener to the current property market situation in China. But either that, we are not seeing big collapse. The prices are down 10%. Maybe secondary market, they are down 15, 20%. That's where the government had to ensure, to engineer what we term as a soft landing, because any further decline will also means that the banks might get involved as well, because that will mean write down in bad assets. So that is the risk for China right now. The Chinese government have to do whatever it takes to engineer a softer landing, a soft landing in the real estate market. And that is actually, in my view, the key concern for China market right now. We are still monitoring the data. There seems to be a bit of stabilization in November and December, but I would still want to wait for a bit, more affirmation of at least a stabilization of turnaround. Okay, that said, again, I want to highlight here is that because of that, we also understand that, US-China tension, this is about world order. And, US view China as a threat. So, for example, you all will have read that, for example, TikTok being a Chinese-owned company, but managed by a Singaporean CEO is being questioned, and that he has to say that he's a Singaporean and he's not a mainland Chinese, and that although he's a Chinese, but he's not a mainland Chinese in terms of. Okay, with that, I think overall here is that maybe you have some questions, we'll leave it to Q&A, but our view here is that we need a bit more information for China, but right now the momentum is with markets like India, like Taiwan. Thank you very much. Thanks.
Okay, thank you very much to Colin. Now we have our next speaker coming up, Claudia from First Sentier. Used to be called First State, right? I think you all know First State more than First Sentier. All right, Claudia, over to you.
Hi, good morning, everyone. I'm Claudia, and like he's mentioned, I'm from First Sentier. So most of you might still remember us as First State Investments back in the day. But what happened was that when we were acquired in 2019 by MUFG, which is a Japanese bank. So right now we're 100% owned by a Japanese bank. We have also taken the opportunity to rebrand ourselves globally to align all our global brands to First Sentier. So some of you might be familiar with some of our strategies, the FSSA Dividend Advantage and also the First Sentier Bridge. So these are some of our flagship funds, and I'll be going through some of the views that the investment team has with regards to Asia and really adding on to what Colin has highlighted. So first and foremost, like what he mentioned as well, markets do move in cycles here. So when you look at here, up and down, right? Maybe 5 years ago or 10 years ago, when we're looking at Asia, we are in a period of optimism, excitement, and thrill, where everyone wanted to get a piece of Asia then. Alibaba was a buy, Tencent was a buy, China was definitely part of your portfolio. But right now, when you look today, maybe we are already past the anxiety, denial, fear part, moving on to panic and also a bit of despondency. So I think what is important and what we have held on within our strategies is the fact that we are very disciplined. We have been investing in Asia since 1988, so 35 years already. So this is a time-tested approach that our investment team has, and we stick by it because we believe it's robust. And sometimes when markets move in cycles, when we're at the point of panic, when everyone wants to get out already of a certain region, a certain country, right? Maybe that is when the point of maximal financial opportunity actually comes about. And that is what we believe in, because we think that in terms of our holdings, there is a lot of opportunity when we look at the valuations. Okay, when you look back at performance-wise, how has Asia performed versus the rest of the world, versus the US? If you can see here, this is a chart actually showing how Asia has performed versus the rest of its peers and also versus the prior decade, which is the green color dots you can see on the screen. So you can see that actually versus the prior decade, Asia in this decade, this past decade has not performed well. And this has largely been due to a lot of reasons. People are fearing China, which we saw the sell-off in the past 3 to 5 years. There are a lot of geopolitical tensions, regulation, also COVID is also part and parcel due to a lot of consumption declines as well. So this has been what is happening. But we feel that regardless of this, there are a lot of opportunities that still remain for Asian countries. And I'll be sharing a little bit more in the next few slides. And when you look at sectors, right, I think all of us know the only sector that really truly outperformed over the past decade is tech. Everything else underperformed the prior decade. And everyone wants to just get a hands on the Magnificent Seven, because I think that is the only few stocks that have been driving the S&P as well. So last year, S&P did very well, 20-30%, NASDAQ as well. But when you remove the Magnificent Seven, actually it's only up about 1-2%. Okay, so it's really driven by all these 7 names, and really we feel that the rest have been neglected. There are still pockets of opportunity there for growth, and you will see in some of the company examples I have. Okay, so before I go through like what we like, how do we think, and our outlook, right? I think it's more important for you to understand actually what is our investment approach first and foremost. How we go about thinking about what to add in a portfolio. So first and foremost, we are absolute return mindset. What does this mean? Is that we don't think that we underperform a benchmark. But when we look at performance, we feel that risk is measured by the loss of capital per month. Okay, so we don't like to compare ourselves to the benchmark. We don't use the benchmark in terms of making any form of decision, but we are truly bottom up. In a regard where you will notice that even though we are Asia ex Japan mandate, you will see Japan inside our funds as well. And this is because of our bottom-up approach. We identify quality companies that are able to perform and sustainably grow their returns and their profits over a long period of time, regardless of how the economy is doing. Okay, so even though the economy was not great for China last year, right, a lot of our Chinese companies within the portfolio still grew 12-15% in terms of profit growth. Okay, and I will be highlighting these examples to you. And apart from that, we also have strong valuation disciplines. What this means is we will not just buy into something which the market thinks is a hot pick. Okay, there's a lot of things that have run up quite a fair bit. Give you an example, India. Okay, we still have India in the portfolio, not to say that we don't have, but a lot of Indian companies have actually run up a lot. So the likes of Nestle, Hindustan, Unilever, all these consumer names, they're trading at 100 times PE. What this means is 100 price, you're paying 100 times for the earnings. We don't feel it's worth it. We used to own those companies because we like them in terms of their management quality and all that. But right now, we think it's a bit toppish. We have cut off. And within India, in our portfolio as well, when you look at the valuations there, it is very reasonable, about 20 times PE. So that is how we have been managing our portfolios in that sense. And this is the outcome of our investment style. So you'll notice that in terms of performance and all that, we tend to do a lot better when markets are down because we are conservative. We like to protect downside. We like to protect all and each and every one of our clients' money. Why is that? It's because there's also an alignment. The investment team, the portfolio manager, Martin, who's the lead portfolio manager of many of our flagship funds, are invested alongside you guys. Their remuneration structure is this way, where a part of their salary for the entire year will be invested into the funds that they manage. This is to create an alignment. So they are also very concerned, and definitely they're disappointed with 2023 because of China. but they do take a long-term approach, 5 to 10 years. And this, you can see here, this is the outcome. When when markets are down, we outperform them about 80% of the time. Okay. When markets are up, yes, we might lag a bit. We outperform 42% of the time, but this actually gives you a smoother journey for the long term, because it is more important to protect on your downside, because you require a lot more capital to catch up once you see such drastic loss. Okay, so this is our outcomes. Okay, when you look at the opportunities in Asia, these three buckets are really broadly where we find opportunities in. First and foremost would be China. We believe it still remains an attractive market, even though sentiment is very bad. Everyone wants to sell China now, don't think it's investable. We find pockets of opportunity in some of the companies we've held for decades already. And we have been taking opportunity in low valuations like times like this to add to high conviction names. Okay, in India, we still find opportunities there, even though it's highly valued. It is still a high quality universe. And last but not least, ASEAN and also Japan that's not here are also regions that we continue to like. Yes. Yes. So what has happened over the past year for Dividend Advantage, which is our flagship fund, we have been reducing some positions in India in favor of China. Okay, so this is a little bit contrarian, and Martin does admit that he might be early in terms of what he did. But when you look at the portfolio, like I mentioned, when there's 100x PE, that's when he's scared. So his view is this: India is actually a mirror of China a decade ago. Why I say this? Now there's record IPOs in India. Okay, last year was a record IPO issuance and also bond issuance. Any IPO you have bought in India last year, you have seen a 40% up. Okay, and this was what was like in China a decade ago. And this is sometimes when such thing happens, it's better to be cautious from our point of view. So we do like India still. I will show you what we like. But we are taking trimming off positions that are too expensive. Okay, we think that there will be opportunity to enter again. And then in China, some of our conviction holdings, which I will show you later, earnings have grown very stably. We still believe in the management team, the quality, but regardless of their earnings growing, price still came off. We don't find that that is logical in a sense. We think there's an overreaction. So we have taken an opportunity to add. But this is not a big swing. So for example, India, we still have 22% in a portfolio. It's very sizable, has always been more than 20%. Okay, in China, it's about 28%. So I would say it's not really a very big, like cut India into zero, then move all into China. No, it's a bit on it. Okay. So in terms of China, we'll talk about China first, the most difficult to talk about. And like what Colin mentioned earlier, yes, when it comes to views about China, it's extremely negative, especially from Western perspective. You search Google image anything, The Economist, it will come out all these like very bad headlines, which is trade without trust, really like the brutal reality of dealing with China. So all this has really made investor sentiment very poor. Foreign investor selling has been its all-time high, right? Even Hong Kong Exchange actually gave a statistic that probably about 90% of global pension funds are out of China already. Okay, so we do believe that it is drastically overdone at the current moment. There are still many opportunities in China, and Martin, which is the portfolio manager, he did mention one thing. He thinks that when the economy is looking tough, probably it is the best time to buy. So he is contrarian in that sense. So he gave the property sector as an example. So right now, probably about 40% of the property developers have already defaulted. So the likes Country Garden, China Evergrande, Shimao and all that, they have already defaulted on their bonds. So those who have managed to survive through this period. So we do hold only one property developer within a portfolio, that's China Resources Land. They are also state-owned in a sense, much more quality in terms of balance sheet. They are at no risk of defaults at this point of time. And what they deal with is high-end malls. So this is the only property developer we have. They are top 10 also. We feel that in the next 3 to 4 years, right, there will be truly a consolidation of market share to all those who survive. Country Garden, China Evergrande are huge. And once they leave the market, can you imagine how much share will go to the rest that survive? So yes, it will take time. There is patience that is required as well. but these are the examples that we still find within China. Okay. Next would be sentiment. We believe sentiment is the one that has been driving share prices. We have Midea Group, which is an example of a holding in our portfolio as well. So Midea Group, some of you may or may not recognize their name. Last time, probably not, but now you will see in Singapore already because they are on the advertisements of the bus, the taxis and all that. They do home appliance. So they are white goods. They do refrigerators, microwaves and all that. And they own the likes of Toshiba also. So Toshiba is a Japanese home appliance. So you can see the green bars are their earnings per share. It has grown stably over the past 10 years, right? Even last year grew by about 12% earnings. But when you look at the blue chart, that's the price, how the share price actually reacted. Because of COVID, definitely it fell. But over the past few years, sentiment really has been the one driving it. There is no fundamentally anything wrong with the company. It's really why we continue to like. We think that their earnings are growing. They're expanding out of China, even into Southeast Asia, into India, right? They are a world leader when it comes to microwaves and refrigerators, but they're still falling. So we don't find that such examples are really show that it is illogical in a sense, overreaction of the market. So we still continue to like this company and we have owned it for many years already. Okay. And also to echo what was mentioned previously, we also feel that China has become a country where they are moving up the value chain. When you look at R&D spending, they have already exceeded Europe. So last time, 5 years ago, you have never heard of BYD. But today, BYD is a competitor to Tesla. People are even moving and considering BYD because of its lower price point. And now it has already exceeded Tesla in terms of sales of cars. Right. So now they are being a big player in EV as well. And when you look at the population, it is very much ready for the move up in the value chain as well. Because when you look at the STEM graduates, those that graduate in engineering, science, tech, math, it has already exceeded US, UK, and it is world number one already. So this is why we like. In the past, you would never have heard of a Chinese company called CATL as well. So they are one of the largest producers and providers of lithium batteries for EVs, and they supply to the likes of Tesla as well. So they are making big changes, okay? And this is one of the reasons why we continue to like China. Apart from that, I think the consumption story is still intact. Yes, consumption has slowed, but when you look at population size, look at their income growth, they are still growing. Okay, household income has still continued to grow last year, even though the market was bad. Okay, it has just been growing slower than expected by investors. Okay, so in this regard, we still feel that premiumization is still a trend that is here to stay. In that sense, we still like a lot of the consumption companies that are able to grow their earnings by more than double digits. Okay, so those are what we like in China. Okay, now moving on to India. So India is a country actually, right? Last time, not a lot of interest because when you look at this chart, the line, right, that is the benchmark MSCI India. From 2010 up to like maybe 2020, it was relatively flat. Didn't really grow for the past decade or so. What is the reason? It's because last time, 2010, nobody dared to invest in India. A lot of scandal, corruption, policy paralysis, all this. When you hear already on the news, you are very scared to put your money there, right? Only what changed was when Modi was elected. So Modi actually really started a lot of reforms. Would have seen demonetization, remove a lot of money circulating in India because that prevents corruption, prevents a lot of laundering and all that. Introduce GST, yes, will hurt certain companies in the short term, especially those that rely a lot on really evading tax, but those that are quality will survive. Okay, and apart from that, he also introduced a unique identification number. Last time don't have, so very difficult for the Indian population to actually get access to banking because they're very hard to open an account. Also very hard to get access to healthcare. Okay? So, but all this is changing. And once they were trying to come out, then COVID hit. But really, in the past 3 years, we have seen India being a star, right? And really coming out because of a lot of the opportunities there. And we also find that India is a long-term and multi-decade story because a lot of its sectors are starting on a very, very low base. what is very interesting is when you look at infrastructure, credit penetration and everything, all is very low. So I'll give you 4 examples that are easy to remember. When you look at cars, right, there are a lot of people in India. Now they are already exceeded China being the largest population already. Okay, but when you look at vehicles per 1,000 people, India is only having 22, whereas the likes of China is 221. So for it to grow, we do expect that to grow as well, and that will benefit a lot of the auto companies. Okay, aircon. India is also a very hot country like us, right? But look at aircon penetration, only 10% of households versus even colder countries like China. So we do feel that there is opportunities there. In our regional India fund, we hold a aircon company called Blue Star, for example. Okay, and what is also very interesting is when you look at oral care. So spending on your toothbrush, toothpaste, Colgate, or tooth floss and everything. How much do you spend a year on all these? They only spend $1 per year, an average Indian population. So for it to double to $2, we find it very possible. A lot of them still don't know about modern technology, oral care products. So this is also an area that we like. And last but not least, when you look at credit, so mortgage loans. Last time in India, they don't believe in drawing a loan to buy a house. They have to have the money. So this is changing as well. Okay, and really when you look at private credit, so really personal home loans, personal credit is a lot lower compared to the rest of Asia. So this is where we find several of the banks will definitely benefit. Okay, so in ASEAN, I think quite a similar story in the sense that it has a large young population workforce as well, and all of them are moving towards digitalization. So the growing adoption of internet and all that is there to benefit. And what is interesting is over the past decade, actually in Thailand, Indonesia, Philippines, it was actually forgotten. When China was booming, ASEAN was really forgotten out of people's mind. When they wanted to set up a factory, they look at China. But right now, with all that's going on in the news and all that, when you look at these countries, we're actually speaking to a lot of our companies that we own. They say actually they might look at all these areas to set up capacity there. So this is actually a signal of confidence for many of these ASEAN countries. Okay, so here are the themes that we see opportunities in. Okay, so first and foremost, as I mentioned, dominant consumer franchises. We feel that this should benefit from rising incomes and also the premiumization trend. This is across India, China, ASEAN. Okay, so there are many consumption needs that you see within our portfolio that we believe will have very sustainable, strong earnings for the next decade. High quality financials. So similar to consumer companies, we think banks should benefit from this as well. So you'll notice that we do have a lot of quality banks, especially in India, but most of them are privately owned. We don't really like state-owned banks. So you will not see a Chinese bank within a portfolio. You will see a lot of the Indian banks, HDFC, ICICI, Kotak Mahindra, Singapore banks, DBS, OCBC, Thai banks, Kasikorn, Indonesian banks, Central Asia. So these are examples. Rise in healthcare spending as well. We believe that aging population and all that would serve as a tailwind for healthcare. So in terms of healthcare, we have a couple of Australian names, CSL, ResMed. CSL does influenza vaccines, and ResMed, they do sleep apnea packs. So really for those that have respiratory problems when they sleep, this is what target. We also have some Chinese names such as CSPC Pharma. Last but not least, tech. So in terms of tech, we tend to prefer hardware versus software. So within our portfolios, you wouldn't see the likes of Alibaba. We prefer tech in terms of TSMC. We have a lot of the Taiwan names, so Advantech, MediaTek, last time Realtek, and then we also have Samsung, for example. But we do as well have Tencent. So that is a company we find is quality. They really are a super app, and we feel that future growth-wise, they can have a lot of monetization from WeChat and Weixin. So just to give you some examples of what we hold. So this is for dividend advantage. HDFC Bank is our top holding. This is an Indian private sector bank. So they have been able to gain a lot of market share from the state-owned banks for a few reasons. They are a lot better when it comes to risk management. Balance sheet is much better. State-owned banks we don't like because they usually are filled with a lot of capital inadequacies, and also they tend to do national service. So when the government says like they want to grow the economy, so more often than not, the state-owned banks will have to do some form of national service in a way. And that is good for the economy, but not so good for shareholders. So we don't hold. So this is an example of an Indian bank that we have. Okay, talking about some of our Chinese holdings, Anta Sports may or may not be familiar to you, but they own the likes of Fila. Okay, so really their market share in China has been growing. You see the bottom chart here. Yes, slightly behind China, Nike in China, but they have already exceeded Adidas. And in China, really, when you look at sportswear, it is a duopoly. So it is really them as well as Li-Ning. And we have chosen them because we find that corporate governance wise, they're stronger. They when you look at earnings, they grew by 15% earnings growth last year as well. So these are what we like. They are now also penetrating different sports attires. They have upgraded a bit higher end. Now they are targeting female and also high-end sports. So Dividend Advantage is a fund that has been around since 2004, managed by the same portfolio manager, Martin Lau. Okay, he is based in Hong Kong. And just wanting to highlight certain key points for Dividend Advantage. This is where we are exposed to. If you have any questions, you can let me know later. So by and large, China, we have about 28%. Okay, India, by no means any small amount as well, about 22. Taiwan, about 12. And then ASEAN is about 15. Japan is our off-benchmark holding. So really the two names that are there now are Keyence and Sony. Keyence. Keyence is a very interesting name. They do robotics and automation. So they are a global exporter. They export a lot and they're one of the leaders because they do machine vision, precision measurements and all that. Okay, this is our top 10 as well, public, and really where we are liking is still what I mentioned earlier. Okay, I want to bring your attention to this slide. So this really compares us to the benchmark. So you can refer to the blue line. Okay, blue line is Dividend Advantage, and then the black line is the benchmark. So over a long period of time since inception, definitely we have outperformed. And right now, the price has corrected quite a fair bit because of sentiment, because of China as well. But when you look at this chart, I think many of you, and I ask you where would you want to buy, you will tell me in 2008. Okay, and I think everyone will have the same thoughts about buying at the low. But I think when you look back even today, maybe buying at 2006, 2007 is not such a bad time. Okay, but at that period of time where there was panic and everything, people probably sold off in 08 and was scared, but then they would have missed decades of recovery. So really, I think the important message here is time in the market is more important than trying to time the market. We can never get it right. We don't know when is the bottom. Okay, I won't say buy today, tomorrow, confirm up 10%. Okay, anyone that tells you that is probably not being that honest in a sense, but it's really over a long time. And we are long-term investors here at First Sentier. Blue and green, blue is without initial charges, so any charges that platform which refer to that. Yeah. Which one? Yes, and that is because what happened was in 2003, most funds probably underperformed the benchmark. Reason being China. So a lot of the stocks that performed in China were either led by AI or they were sanctioned. So like the likes of Sinopec, China Mobile, we do not own. China banks last year also done well because of down trading. We don't own them. So what does this mean is down trading means that banks have been the state-owned banks, Bank of China, China Construction Bank, giving some examples, have not really done well for the past over a year. And so valuations were super low. So people were actually picking up those stocks, but they are not quality in our opinion. Okay, so that's why we don't own them within the portfolio as well. And that is why we underperformed last year. Yes, so mostly financials in China, which we don't own. A lot of the telecoms also we don't own that have done well. So really everything that has done well in the benchmark last year, we didn't have in our portfolio. That's why in 2023, we had underperformed. So I will show you another chart. You know, don't have. Oh, Ping An is an insurance company, but it used to be, but we have reduced the position. What is the reason? Is we find that there's a little bit of risk going on there. There was a news that recently come out that says that a rumor that says that Ping An, they have been asking Ping An to bail out Country Garden in that sense. So with that risk, we have cut the position slightly. So it is within a portfolio, but it is not within our top 10. Yeah. So over the last year, within Dividend Advantage, we have been consolidating our holdings as well. So right now we have about 51 holdings, and the top 10 makes up about 45% of allocation. So it's getting more and more convicted in that sense. Yes, yes. Global growth or Asian growth? Asian growth. Maybe I speak to you later. I don't believe we have a global fund for the FSSA team because the FSSA team only manages Asian equities and emerging market equities. So it might be a different fund that you're talking about. But if you're talking about Asian growth, we also have on the platform. Asian growth is managed by a different portfolio manager. It has done well over the past few years, and because they're a little bit lighter on China, that fund Asian growth has much less exposure to China, about only 10%. Yeah. Maybe we'll go through some questions after this, and then I'll pass the time on to the next speaker first. But thank you so much for your attention, and I look forward to chatting with you more later. Thank you.
Okay, thank you very much, Claudia. So next speakers are from Eastspring. Okay. Okay.
Hi, Happy New Year. Yeah. Thank you all of you for staying till the end of this. This is the last segment. I'm from Eastspring Investments. My name is Joey. So I'm just here to do a quick intro before I hand over to my speaker, Dexter here. All right. So for the very last segment, right? My speaker, which is Dexter Tan, our client portfolio manager, he has over 17 years of financial experience. He used to work with NUS Research Institute as a credit research associate. He was also with Fund House as Eureka Hedge, a hedge fund house, doing hedge fund analysis as well. Interestingly, he also worked with Philip for a period of time before joining Eastspring. Okay, so today he will go through a brief summary of our views of the market. I know you hear a lot. We will be fast. We promise that you'll be short, a summary. And then we will also highlight that actually we do have similarity. We do see that Asia as one of the fastest growing markets. Just to share, we also have an Asian equity fund that has performed very well. It's called Asian Low Vol Equities. 1 year about 13%. So it is very ideal in this environment. Today, we also want to highlight why you can consider having high quality investment grade bonds in your portfolio. So we'll go into Sing Dollar bonds and share a bit of our fund. Okay, do pay attention. Toward the end, we'll close with a quick pop quiz. 3 questions because I have 3 prosperity what dragon to give out. Okay, to give you all good luck, let's all have great health, prosperity, good luck this year. Okay, so please do pay attention. Very simple questions. I'll hand it over to Dexter now.
Okay, thank you. Thank you, Joey. Yeah, so It's a pleasure to be here. So my name is Dexter. I'm a client portfolio manager from the Asian fixed income team at Eastspring Investments. So just a bit of a background, Eastspring Investments is owned by Prudential. As many of you know, Prudential is a big company. It's one of the largest financial institutions in the world. Eastspring is also one of the largest asset managers within Asia. Eastspring manages about 260 billion of assets under management, out of which the Asian fixed income team manages about 45 billion of assets under management. So part of it is also including Singapore bonds as well as the Eastspring Investment Singapore's Select Bond Fund. So yeah, so as you know, we are approaching a Chinese New Year, so I think later at the end of the presentation, we will have a pop quiz, and then you can have a chance to win the Huat Dragon. So I think this Huat Dragon, I think any idea why it's called the Huat? So and if you look at it, right, it actually looks like a Huat Kueh. So you bring back, you confirm Huat one, so it's like a Huat Kueh, you can bring it back home. So the dragon is actually a symbol of power and energy in the Chinese zodiac. So, and also we are happy Chinese New Year to everyone. 祝大家龙年行大运，龙年龙马精神。Okay, so I think I think the previous two funds were on equity funds, so it's a bit different. We are focusing on fixed income. So fixed income is a very unique asset class. So it's more stable compared to equities. And when we talk about fixed income, we talk about the market outlook. There are a few things which we focus on, which is mainly on interest rates. So interest rates have an impact on bond prices. So as I think Colin has mentioned earlier, when interest rates fall, bond prices go up. So, and interest rates are actually set by central banks. So which is why when we look at fixed income assets, we also pay attention to what the central bank is doing or what central banks, whether they're keeping interest rates or even cutting interest rates. So for central banks, right, when they look at, when they set interest rates, they look at a couple of things. First of all is growth. Secondly is inflation. And thirdly, job market. So these are three things which central banks pay attention to when setting the interest rates. So I think if we saw the slides earlier, I think Colin flashed out a few slides on growth. So growth is actually slowing. So I think you saw the one on IMF on China, growth in China is about 5.2% last year. So it's going to drop. The forecasted growth rate for this year is about 4.6%. So for Singapore, in 2022, it's about 3.6, so dropped to about 1.2%. So effectively, it's so slowing. And in the US, growth is about 2.5% last year. It's projected to slow to about 2.1% this year. So growth conditions are slowing. On inflation, where we say inflation, we have to really think about what has happened a few years back, what has led to this rise in inflation that what we are seeing right now. So in 2020, we had this COVID-19. So 2020, there was COVID, and then a lot of businesses were affected. So businesses were shut down. So central banks actually cut interest rates at that point in time. So 2020, they cut interest rates, and interest rates were kept at a very low period, extended low level for extended period of time. So between 2020 and 2022, there were low interest rates. And at the same time, there was also economic stimulus. So this economic stimulus has actually pumped up prices. So which is why we see inflation has gone up in various countries. Like in Singapore, we saw it reach 7.5% in 2022. But then inflation has turned since then. So from 2022 down right recently, inflation has decelerated. So inflation is slowing. And the third thing which central banks also get is jobs. So I think if we look at the news recently, Lazada has announced job layoffs. And I think just 2 days ago, the Ministry of Manpower has also announced that retrenchments have actually doubled in 2023 compared to 2022. So overall, I would say job conditions have softened. US non-farm payrolls have also been on a declining trend. So I think growth is slowing. Inflation numbers are softer as well as job numbers are also softer. So I think this is actually ideal for fixed income, especially for investment grade bonds, especially for Singapore bonds, which is and for the Eastspring Investments Singapore Select Bond Fund, which is predominantly investing in investment grade Singapore bonds. So just to give a recap of what has happened in 2023, I think last year everything was pretty much in positive territory. So this is what you're seeing here is the asset class performance of various assets. So virtually there's a big rebound, especially during the fourth quarter. There was a big surge whereby when treasury yields were actually coming down from as high as 5%, and the yields there were lower treasury yields, and that boosted the returns of the fixed income assets as well as equities in general. So for the firm, right, our firm view is that we share is pretty much similar to what it shared earlier. So we think that growth is going to slow, inflation will be slower, as well as the interest rates will be kept on hold. So I think in the past couple of meetings from the Federal Reserve, they have kept interest rates on hold. So for about 3 consecutive times, MAS is also kept an accommodative monetary policy, and that will be positive for fixed income. So which is why we are positive on fixed income in general, especially for investment grade. And here we have US inflation. So inflation, as mentioned earlier, has been slowing down, decelerating. Here we have on the left, you have the US wages. And then on the right, we have inflation data, inflation expectations, which has turned around since 2022. You can see that there's a turnaround in the graph here. So inflation is slowing, which is all positive for fixed income. China, with regard to China, I think there's a bit, we have pretty much the previous speakers have really elaborated. So China, for us, we also view that it's slightly more conservative on China. Monetary policy has been easing. If you look at China's loan prime rates, they have also been cutting. The central bank over there is keeping an accommodative monetary policy. So of course, one of the drags is the property sector. So, and of course, with regard to property, the government has also announced a series of measures to support the property sector. I think in 2022, there was this the 3 green arrows, which is a series of measures to help boost up the confidence in the property sector. But I think I think much has been done, and I think so our view is that much more will still need to be done in order to boost confidence in China. So from a fixed income perspective, I think also recently in December, I think Moody's has also cut the outlook for China sovereigns to negative from stable, and also for the banking sector to negative from stable. So overall, I think it's actually a good thing for investment grade, because investment grade yields are actually attractive at this level. So the yields have actually gone up, and it's good to invest in investment grade bonds at this point in time, especially for Singapore bonds, which we think is an attractive asset class. So just to give you some perspective of Singapore bonds. So Singapore bonds, when we say Singapore bonds, right, they can be corporate bonds or government bonds. If we look at the corporate bonds, which the fund invests in, the Eastspring Investments Singapore Select Bond Fund invests in these corporate bonds. So when we think about Singapore companies, on the left, you see the chart. The Singapore companies have lower gearing compared to other kinds of companies like average of Asian companies as well as North American companies. You see the blue line on the left. The red line is the Singapore companies is much lower compared to the blue line. So it's because the Singapore companies are less geared. So this is positive for fixed income, because fixed income, right, unlike equities, when you buy equities, right, you focus on the upside. But for fixed income, we focus on the downside. So the idea is really to invest in bonds, collect the coupon over time, and at the end of the maturity, we collect back the principal while avoiding the default. So that's the credit risk. But for equities, they look at the upside. So when the company is low geared, it means they have low gearing. So it's good, it's positive. It's positive for investors who buy into these companies. So these are Singapore corporates. The profitability has improved and debt servicing ratio has also improved. And for Singapore bonds, right, there's institutional demand. So it's good to know that actually there are a lot of institutions out there who buy these Singapore bonds. And so when you buy Singapore bonds, you're actually co-investing together with them. The reason being because like institutions, like insurance companies, right, they want to manage their liability books. So they manage the liability books and they buy into long-term bonds, long duration bonds to collect the returns over time to match their liabilities over a period of time, which is why you see here that the assets of Singapore insurance companies are going up, and this is shows that there's institutional demand for these long-term Singapore bonds. Now, historically, Singapore bonds have provided stability in volatile periods. So when you buy bonds, right, you're like driving. So all of us have different investment journeys. Some of us are planning for retirement. Some of us are planning for your children. So you have all of us have different journeys. But when you buy bonds, right, you're actually driving a car. It's like an investment journey that is very slow and steady. That gives you kind of stable kind of returns. So when you drive, right, you see, okay, maybe in front of you there's a lot of potholes or there's going to be speed bumps. So in order to drive, you don't want to drive too fast, because if you drive too fast over the speed bumps, the car may swerve and then you may get into an accident or something like that, hurt yourself. But you buy bonds, you have these you drive slowly, you overcome the speed bumps and you reach your destination in the safe and sound manner. So this is really, so if you look at the returns of bonds, investment Singapore bonds, like for example in 2004, 2006, when they were hiking rates, actually Singapore bonds were actually positive during that time. And then during the global financial crisis, as you know, Lehman Brothers collapse, so the bonds were also positive. So in fact, they were negatively correlated to equities. So here we have equities, the returns of equities and bonds. So it's always good if you see that the fact that we're seeing that bonds are giving positive returns during a great financial crisis shows that there's actually some benefit to adding bonds to your portfolios. And is negatively correlated, so it helps to smooth out the volatility within the financial markets. So as recently in 2022, when they were hiking rates, bonds also outperformed other asset classes. So even though they was negative, but it still fared better than most other asset classes. So the fund, the Eastspring Sing Select Fund Bond Fund, actually invests in corporates. So corporates have done well since 2022. We see that the rate line has been going up in a general upward fashion since the start of 2022. And here we have of course, one of the concerns about bonds is that interest rates. So historically, right, if you look, I mean, you see, like for example, in years like 2004, 2006, when yields were actually going up, Singapore bonds were also positive at that point. So when I mentioned about yields, we talk about interest rates and yields, they were going up, but the Singapore bonds actually were positive in 2004. So it's not always true that when yields were going up, bonds could be negatively impacted. So it shows that this asset class is pretty much quite resilient, especially during historical periods. And you can see by looking at the various different time periods from 2001 to 2003, 2023. So over different periods, it has given investors stable returns. So why should you invest in Singapore bonds right now? Well, the simple reason is that yields have gone up very high and it's very attractive right now. So the concept is very similar. I know many of you may have bought T-bills. So the concept is very similar. So you're actually locking in the yields at this rate, but instead of, so a T-bill, when you talk about MAS T-bill, it's actually an unrated bond that is issued by MAS, giving you a 4%, or even now, I think it's gone down to 3.5%. So the yields have actually gone down. So similarly, right now you're looking at yields, investment grade bonds, yields have gone up and they're trading at their highest levels in decades. And right now you're looking, you can lock in these yields at these attractive levels. Okay, so more on the Singapore Eastspring Investments Singapore Select Bond Fund. So this fund, there are a couple of reasons. to invest. It gives you stable returns and a regular payout. So it's on the standard deviation basis is 4.5%. So if you drive to the right, it's 4.5%. You drive to the left, it's just 4.5%. So that's one standard deviation from the mean. Okay, so the focus is on high quality bonds. It's a high quality portfolio, A plus on average. So the fund is benchmarked against the market iBox ARBI index. So this is the benchmark and it has consistently outperformed the benchmark. So Morningstar, which is a fund consultant, has recognized this, and they award various stars to different funds, and they give very high 5 stars to those funds who outperform their peers every month. So this fund is 5 Morningstar ratings. So this is within the top among peers, and on a 10-year basis. So 10-year basis is 5 Morningstar. So it shows that the fund has delivered alpha over the long period of time. So the fund is incepted in 2011. So also it has a very long track record, and it has a long track record of outperformance. So it also buys Singapore government bonds. So Singapore government bonds is AAA rated, very low credit risk. And the way it tries to outperform its benchmark is it overweights the corporate bonds. So corporate bonds pay higher coupon compared to government bonds. And so you collect the higher coupon over time from these corporate bonds, and that's how you outperform the index over time. So here we have a chart of how the yield advantage. So here instead, so the benchmark is very heavy in government bonds and less so in corporate bonds, but the fund is overweight corporate bonds and underweight government bonds. So the yield, there's a yield pickup, so it's about 4.2% if on average for corporate bonds, and that is the yield pickup for the fund. And some of the examples of the bonds in the portfolio, so I mean, this is not examples, but examples of corporate bonds that are available for investments. So these are some of the choices that the fund can invest. They can invest in DBS bonds. So not only there's DBS stock, DBS also issues bonds to investors. So sometimes when DBS wants to raise money, they can go to the bond market. They will call an IPO. There's a bond IPO. And for example, if DBS issues a bond at 3.8%, matures in 2028. So tomorrow, maybe, okay, DBS is issuing a bond at 3.8%. Should we buy into this bond? And it will mature at the end of 2028, we'll get back our principal. And not only that, from now to 2028, we collect 3.8% every year. Okay, so these are some of the examples of the bonds that the fund can buy. There's also names which are very familiar. When we say Singapore bonds, Singapore companies like Keppel, Mapletree, Singapore Airlines, Singtel, UOB, and so on. So it's stable. It's a high quality portfolio, and there's also the flexibility to actually invest in non-Sing dollar bonds. So non-Sing dollar bonds can be US dollar bonds. So sometimes US dollar bonds give higher yields. So for example, if we see Alibaba also issues bonds. Alibaba, the bonds are trading at maybe 5-6%, especially during when there's a lot of China uncertainty. We can see that the Chinese bonds are also trading at much better valuation. So if we think that is attractive, then we can add these Alibaba or even or Meituan or Xiaomi bonds into the portfolio. Then on a hedge to Sing dollar basis, it will still add the yield to the portfolio, and this yield will also be added, given to investors like yourselves. So a bit more about the team. The team has won awards over the years. Like I said, so in 2021, we were recognized as the best fixed income house by Fund Selector Asia. In 2023, we were top investment house, Asian G3. So this is by Asset Benchmark Research. We were number 1 in 2023. We were number 1 in 2021 and number 1 in 2019, according to the Asset Benchmark Research. So I think, so now I'll go to performance. So this is also important. So performance, like I mentioned, is consistently outperform the benchmark. So you see here, we have a red line, and then we have a yellow line, and then we also have I think it's a gray line. So the red line is the fund's performance, it's outperformed the benchmark over time. Since inception is about 3% on a bit-to-bit basis. 10-year performance is rated 10 5-star Morningstars by Morningstar. So this is like investing in high quality bonds. So it's something which you can invest and then you know you're pretty assured and it helps you stabilize your portfolio over time. So last year, the bond market, not only the equity market has done well, in 2023, as shown earlier, the fund has actually gone up by 6.8%. So last year was a pretty phenomenal year for the fund. It's positive rolling 5-year returns. And on a calendar year basis, the fund has outperformed the benchmark. So what we are seeing here is different calendar years. And then the green bars are actually whereby the fund has outperformed in that particular calendar year. So it's incepted in 2011 and it has outperformed the benchmark for 10 out of 12 calendar years. Okay, so this is a very important slide. So this is a snapshot of the Eastspring Investment Singapore Select Bond Fund. So here the fund size is 1.3, more than 1 billion. So it's actually the biggest long duration bond fund that you can find available in Singapore. It's denominated in Sing dollars and it's benchmarked against the market iBoxx ALBI Singapore Index, and you can use your CPF to buy into this fund. Okay, so the fund is paying right now 4.5% distribution. So I repeat, the fund is paying a distribution yield of 4.5%, and it's been screened by CPF board to invest. So CPF board has classified it as a low to medium risk fund. It meets the CPF board's criteria of a low total expense ratio. So total expense ratio is about 0.6 compared to the cap of about 0.9. So they have also CPF board has also assigned Morningstar to regularly we have to interview with the fund managers every year. They follow up with us. They check on us on updates, and we provide information to them on a regular basis. Okay, so now I'll go into fund details just to give you a flavor of what we'll be investing in. So this is the fund is diversified compared to the benchmark. It's about 155 names, 155 bonds, yielding average yield to maturity is about 4.2%, duration about 7.8. So of course, if you have the view that interest rate will fall, the long duration bonds will benefit, the bond prices will go up. So long duration bonds will do better than the ones that are short duration. The average quality of the portfolio is A+, and 70% of the portfolio is investment grade bonds. So here are some of the countries. So being a Singapore fund is predominantly in Singapore. Of course, there's the flexibility to invest in non-Sing dollar bonds, such as those in Asian bonds as well. So it's overweight corporates compared to the benchmark. As you can see by the red bars, there's a heavier weighting on corporate bonds. And here we have the maturity profile as well as some of the names in the portfolio right now. So we have LTA, we have NTUC, we have Standard Chartered, CapitaLand, Keppel Corp. So these companies issue bonds and we buy into the bonds of these companies. Okay, so with that, I think I'll take a pause or if you have any questions. So there's a so the distribution has been raised to 4.5% last year. So on average, if you check, it's about 2.9% since inception. Okay, so as interest rates go up, you adjust the dividend payout to be higher. This one is where negative. 2022, yeah. So this one 2022, right? All asset classes down. So the benchmark, no, this one is the return. This one is the price drop, price return. Yeah, price. Yeah. So stocks drop also, so bonds also drop. So you just can see a lower return. No, there's still payout. In fact, we have never we has been consistently paying every quarter. Yeah. So it's an unrealized mark-to-market position. Yeah, so if you're looking for payout, you can look at the distribution yield. So it's about 4.5%. Yeah. At this current juncture, yes.
So we were sharing, the gentleman was asking about the dividends payout by the fund, right? So before the aggressive rate hike, rates were much lower. So back then we were only paying about 2.7. Then when the rates start to hike, right, we actually increased to 3.5. And then subsequently, early last year, we increased to 4.5. So as rates it go up, we will also try to adjust to give our investors more dividends payout in that sense. Okay. So then the gentleman was asking about the performance. So as we saw the chart just now, out of the many calendar years, the fund has been around for more than a decade. We outperform the benchmark every year. Okay. But for the 2 years, right? One was the China-US tensions, the 2018, which market suffered quite a bit in the Q4 of that year. The other one is 2022 because of the aggressive rate hikes, right? A lot of bond funds kind of suffered. But there was also one chart that he shared. Despite bond funds suffering, compared to the equities market, compared to other share class, these Singapore bonds actually still fared much better. But gentleman is also right to say that as long as he continue holding the bond fund and continue collecting the dividends, he could just wait out for the NAV price to recover from that. So he is also right in that sense. Okay. So just to share that this is an investment grade only, high credit rating, A plus average credit rating. So we call it quality investment grade bonds, which is ideal for times where it is more volatile. And I'm sure all of you realize in recent years, the market swings very fast, up and down. There are more volatility, more swings. And I'm sure all of you as savvy investors, you probably have your own crypto, your own US market stock, tech stock, stuff like that, right? So we are just recommending that you can consider adding this bond fund to your portfolio, high quality bond fund, to have a bit of buffer and to collect a bit of dividends. And because of that high duration that we saw just now, 7.8, so if we expect the rates to cut later this year or even next year, which eventually will happen, we will be looking at the potential bond price appreciation in that sense. So therefore, we highly recommend that you can consider adding this to your overall allocation. Okay. Do we have more questions? This lady over here. Yes, you're right. Okay, so over here at Eastspring, we are quite prudent and conservative. When we set a rate, right, we do not expect to change the rate on every quarter and stuff like that. So when this rate was set early last year, we do foresee, and we do have a very experienced fixed income management team that we're able to hold this rate for at least last year and this year for about 2 years. But yes, at the end of this year, should there be aggressive cuts, then we will need to review the rate. We have to be sustainable, we have to be prudent. If the rates were to drop, we would have to review this payout rate. However, we will also be looking at that potential price appreciation. Okay, so currently we really see it as a sweet spot, because when was the last time yields are so high? that you are able to pay such good rates, right? So you want to capture that yield. And if the cut were to come, which we don't know end of this year or early next year, then you take part in that price appreciation potential. So that's why people are starting to look at longer duration bonds for that sensitivity to price changes in that sense. Okay. This is OASA approved cash and SRS as well in that. It could be, but do consider more for OA because you have more difference, you see, because OA is about 2.5, 2.6, right? Yes. But then you really have to go and, so we encourage more for OA and cash actually. Yeah. That gentleman has a question. Okay, for initial charge, right, it's not charged at fund house side. It's actually by the distributor. So you would probably need to check with Philips or Poems how they charge. Yeah, because at fund house side, we don't charge that initial sales charge. Management fee is 50 bips, 0.5. You see this chart here? That's the management fee, 0.5. Yeah. Yes and no, because your total return will also encompass the price appreciation, the net price. Yeah. Dividend is one component. You still have your price, net price. Okay. All right. I've been told that we kind of overrun. So before we end the session, thank you all of you. Just a quick summary and the pop quiz, okay? The 3 questions. So a quick summary, thank you all of you. As we shared our views, we still see that Asia is the fastest growing region and very, very favorable. We do have two funds to look at. Today, we actually focus on Singapore Select Bond, which is investment grade quality with 4.5 quarterly payout dividends. We also do have an Asian low vol equity fund that has performed very well. Do consider and take a look at that as well. Okay. So before we end, I just want to ask 3 very simple questions to the people that are in-house here. Thank you for staying true and listening in to us. Okay. So the first question is very simple. Do raise your hand. What is the name of my company, my fund house? Raise hand. Okay, this lady here. Eastspring Investment, thank you very much. Yeah. Okay. Second question. What is the, raise your hands, what is the name of my fund that I'm promoting today? Here, nobody raise hands. Wow. Okay, that gentleman there. Thank you so much. Wish you 龙年行大运. Okay. Okay, the very last question.
You better.
My Singapore Select Bond Fund, what is the dividend rate per annum? Okay, that Indian lady? Yes, 4.5% per annum, paid quarterly. Thank you so much. I wish you all great health in this dragon year. Have a prosperous year with lots of love, joy, and fun. 祝你们龙年行大运，龙马精神，快快乐乐，谢谢。
Okay, we have the final 10 minutes of questions. So those of you who got questions, feel free to ask. We have some online ones. Joe, you happen to be the online question is for Eastspring one. So yeah. It's for online.
If you look at the Sharpe ratio, is it underperforming? Do I have the Sharpe ratio data? Let me see. I don't recall. Sorry, please give us a while. The screen just blacked out. How do we see the bond prices for Asian high yield? Okay. Okay, I'll try to get my investment specialist back here. Okay, but for Asian high yield, right, it is highly into Chinese bond. How do we see?
Asian high yield, for Asian high yield, it's an online question. So I think for Asian high yield, generally the team is rather conservative on Asian high yield at this point in time. So compared to Asian high yield compared to investment grade, we will still prefer investment grade over Asian high yield. I mean, if you look at Asian high yield, of course, the long-term growth story is there. If you look at maybe 5, 10 years, Asia will still be around, the Asian high yield market will still be around, just that maybe on other areas within Asian high yield would be more attractive. For example, like Indonesia or even in India would be more attractive within the Asian high yield bond market. But collectively, the team's view on Asian high yield is more conservative at this point in time. Yeah.
Might be a better consideration, right, when the market start to see more growth and recovery.
The Sharpe ratio is actually a reflection of, so Sharpe ratio is returns minus risk-free rate over standard deviation. So the fact that you're seeing negative, right, is because of what has happened in 2022. So in 2022, the most of the bond funds were down, as well as equity funds were also down. So which is why on a 3-year basis, the Sharpe ratio is negative. Yeah. So it's a reflection of what has happened in 2022, and that is not it's unprecedented rate hikes that has impacted the bond price. So yeah, I think yeah. So Joey is correct to point out that in 2023, the bond prices have actually recovered. Last year, the fund has gone up by 6.8%. So the growth outlook is more positive for bonds, given that interest rates are. We are expecting the Federal Reserve to pivot this year, and the funds long duration bonds were expected to give a positive returns for this year. So the momentum is picking up. It's going in the right direction. So it's still good to look at investment grade bonds such as Singapore bonds.
Okay, so thank you everyone for tuning in today. If you have any final questions, just type in the chat. Anybody you want to address? Of course, if you're invited by your financial advisor to this event, feel free to reach out to them to get more info, how to buy, how much they charge, so and so forth. For okay, I think they'll go. Okay, so I think that's it for today's event. If there are no further questions, yeah, basically that's all for today. Okay, I have an online question. Let's see if any of our managers can take it. Oh. So I got this online question. What is the net result when the yield increase at the expense of price? Let's see if any of our subject matter experts can take this question. Just give me a moment.
Oh, hello. Hi. Joey from Eastspring here. I see that there's a question, what is the net result when the yield increase at the expense of price? I am interpreting this question as you and dividend goes up, but your net price drop, which is like a 2022 type of scenario, right? So as discussed earlier, 2022 was a result which is a pretty rare year where both equities and bonds are badly hit. But basically for customers that hold true, they are not realizing the loss in a way because they actually hold true and market has since recovered. So in the meantime, when you're holding true, you continue to collect the higher dividends because of that higher use while you wait for the price to recover in that sense.
Okay, hope that answers the question. Okay, I think we have reached about 12 p.m. I think that's all for today's seminar. Thank you for everyone's attendance.